I'm Alan Kenny, Editorial Director with REIT.com, and I'm coming to you from REITWeek 2013, NAREIT's Investor Forum in Chicago. Joining me is Michael Hudgins, Real Estate Strategist with JP Morgan Asset Management. Michael, we've seen a lot lately in the news about commercial real estate pricing and how it's essentially hit peaks that were last seen in 2007 before the financial crisis. Can you tell us, how's that impacting your outlook for the REIT market going forward?
Well, there's two things I like to, does it impact my outlook for REITs? And it's really a yes and no answer. I apologize. But the yes is, well, I'll start with the no actually. On the no, why doesn't it worry me? Frankly, investors like to use the index as a simple kind of shorthand way to say, is an asset class inexpensive or expensive? If it's below its peak, it's inexpensive. If it's above its peak, it's expensive. And that's frankly far too simplified and frankly a little bit unsophisticated. You have to remember that REITs right now are growing cash flow from a depressed base. Right? They've moved past this peak, but still are generating NOI at the property level of about 4% year on year. Right? Additionally, I see no reason why with low supply and incremental demand that REITs can't continue to grow that NOI at a 3% year on year rate for the next couple of years. What that means is that year on year, as the cash flow increases at the property level, value should increase. So I don't really have a problem with the market moving up past its peak. And in fact, once again, investors should remember the reason why we invest is because indices over time continue to move up. Every day, indices are passing their previous peaks. That's not a real issue. On the yes side, what does concern me a little bit is that cap rates, until the recent events, cap rates were in the vicinity of their previous troughs. Okay, that's not truly an issue as long as the property itself is healthy, and that's indeed the case. With cap rates stable where they are, with healthy real estate generating cash flow, REITs are capable of generating core property-like returns of 8 to 10% of the coming years, with yield plus growth in the cash flow. However, what I think the last week has reminded us is that the cap rates where they are, if the underlying 10-year, if the underlying debt costs do get volatile, it will inject volatility into the REIT market.
So then are REIT shares fairly valued?
When I talk about valuation, I like to remind investors, remember, REITs are kind of a blend of three things: real estate, equities, and bonds. To really understand or make a judgment or assessment of whether REITs are fairly valued at any given time, you must consider what I call the REIT valuation trinity. You have to look at REITs versus equities. You have to look at them versus bonds. You look at them versus real estate. If all three signals say that REITs are inexpensive, that's when I can go to clients and investors and say, you need to accumulate a strategic allocation of REITs and add a tactical. If every measure suggests that REITs are expensive, that obviously is a signal to reduce. If there's a blend where some are expensive, some are inexpensive, then I say, you know what, maintain some sort of strategic allocation. When I look at REITs right now, they look expensive versus equities. I think we all know that. They still, even given the rise in rates just recently, because REITs have come down, they still look slightly cheap versus bonds. The tiebreaker is real estate, and that's a tougher one. If you look at real estate, there are, I think as of yesterday, about a 10% premium. REITs are trading at 10% premium to the value of the underlying real estate. On a historical basis, though, they average about a 4 to 5% premium. That's a 5% premium above where they should be, I would say. I don't find that a problem at this point in the cycle. Why? Well, having that premium to their net asset value allows them to issue equity accretively and use that capital to create value for their shareholders. Right? REITs have unprecedented access to capital in various forms right now. We're at a point in the cycle where they're able to use that capital to create value. So rationally, REITs should be trading at a premium to the real estate. So I look at that and I say it's a slight but rational premium to the real estate. I'm not truly concerned. So I think it's fair to say that REITs are still a maintain.
So Michael, then let's talk about the next 6 months of the year. What's going to be the big story in the REIT market?
I'm just personally curious to see how single family housing REITs do. Do they demonstrate that they can actually be cash generators? I think that's going to be critical, because if you're going to be a REIT, it's all about generating cash and paying out a dividend. So it'll be interesting to see if they prove out that business model for their investors. What I'm watching very carefully is to see why do REITs rebound in the coming months? Is it because bond investors realized that they were too concerned too early and bond yields come back in? Or is it because the US economy does really get traction? The cash flow growth at the property level for REITs accelerates. And as a result, investors realize the real estate is healthy and they come back to our space to take advantage of that.
All right, well, thank you so much for joining us, Michael.
Thank you for having me.
And for more on this and other news and analysis from REIT Week 2013, be sure to check out REIT.com.